Today, 80% of businesses don't sell. To be a part of the 20% that do, and at maximum value, you'll need a successful strategy. Welcome to the Defenders of Business Value podcast, where we interview today's top professional advisors who help business owners create, preserve, and most importantly, transfer value. If you want actionable tips that will increase your business value, stay tuned. The podcast starts now.
I'm Ed Meisigland. I help business owners understand the value in their company so that they can sell their business when they want, how they want, and to whom they want. On today's show, you just have me. It's been a while. And I guess the first thing is I want to say thanks. Seth Godin says, would they miss you if you were gone? And so I heard from a number of people over the last 6-8 weeks, was I okay? And so on and so forth. And so for all you that reached out, it means a whole lot to me that you did. And I'm good. Let's play a little catch up. This whole COVID thing, it really is something. Personally, the kids have hybrid school, and so that's a whole different dynamic. My wife is a therapist, and she had started her practice early on the last year or so. All the challenges surrounding mental health, those things are real too. So she has a backlog. I think she's 14 deep on a waiting list. To make matters worse, her dad died. And you want to talk about, for all those people that have lost people during this whole COVID thing. Her dad went into the hospital on Saturday, was in hospice on Monday, died on Thursday, COVID funeral on Saturday. It literally went that fast. And as far as a sad process, it really was. So all those people that are facing similar challenges this time of season, boy, I feel for you too. So then moving on to the brokerage. Everybody asks, how is the deal-making world right now? I'm going to tell you, it's not bad at all. A lot of the businesses that we've been blessed to work with, they're still hanging in there and deals are getting done. So where have I been? Well, in the practice, a couple things happened. One, we had a marketing director went on maternity leave, which I thought I was ready for, and it proved that I was not. Fortunately, we had some great interns that did just truly a remarkable job, but nevertheless, it took considerably more time than I anticipated. Next was our broker support person. She had resigned to take another job, and it's a great job for her, so no hard feelings there. But what I didn't realize, and, even though, in doing my valuation work, I do bump into just about every business owner that says labor's really hard. And so we went out and we were soliciting a lot of people to apply for the job. And I think I went through 283 people, 41 people that I extended interviews to. And of those, only about 20 showed up. And of those, I'm trying to think, I want to say, it was considerably less than that. I want to say like 8 really had an interest in the job. And so that was a little disheartening and just totally ate a bunch of time. The good news is we found a real good person, and we're real excited that she's joined us, and we're going to move down the road with her, and we're looking forward to her making big impact in the business. So back to the business. We haven't missed there hasn't been a whole lot of COVID related stuff that has caused deals to go bad. We're very, very fortunate that we have not been affected. Now, as with most years, either we're going to have a good year or we're going to have a great year based on November, December. We're a fourth quarter organization. And so, I'll let you know here in the next couple months how that turns out. Moving on to today, I'm going to play a little catch up. There's been a number of reports that have rolled out that I wanted to share with you. A couple things I wanted to talk about was, one, I've received a number of questions how the PPP loan, how that affects business value. So I'm going to address that. The M&A Source third quarter report is out, as well as the Deal Stats third quarter is out. One of my buddies over at the National Christian Foundation sent me some correspondence on charitable giving at the end of the year. And then lastly, one of my buddies over at Live Oak Bank, he shared some of their survey results with their constituents. So it's going to kind of be a potpourri, kind of like since I'm recording this right before Thanksgiving, it's kind of like a potpourri of information for your Thanksgiving dinner. So I hope you enjoy it. And so let's get at it. All right, we'll first begin with the question on handling business valuation related to the PPP loan. So for those of you, you know what, it's silly for me to even say it, but nevertheless, for those of you who are unaware of the PPP, that is the Payroll Protection Program. That was part of the Economic Security Act known as the CARES Act, or Corona Aid, Relief, and Economic Security Act, and that's the acronym is the CARES Act, or that was enacted to protect the payroll for companies, self-employed, sole proprietors, and non-for-profits. Anybody that was a business or an independent contractor could apply for it, and they could receive a low-interest loan to help them keep people employed. So now there's discussion about whether or not it's going to be forgivable. So in the meantime, there are companies that require to be valued. And how do you handle the PPP? So the PPP originally was basically you divided your annual payroll by 12 and multiplied by 2.5, and that gave you your PPP loan. So as we move forward, there's three approaches to valuation: income, market, and asset. So first, let's begin with the asset approach. Until we know whether or not it's forgivable, it is a liability. Simple as that. And you treat it as such. So it went in as cash, it was used, and then there's a liability for the PPP loan. And so if you're looking at the asset approach, which is just an assemblage of assets, that's a liability and you have to net it out. On the income approach, it's a little bit different. In developing your capitalization rate or your discount rate, obviously you're going to, if you're using a weighted average cost of capital, you're going to need to address the interest rate for the PPP loan liability and build your capitalization and discount rate accordingly. Back to the asset approach, remember we netted it out at the end? Well, we're going to have to net it out again for the income approach because, again, it's a liability. And then finally, the market approach, like the asset approach, it's a liability that you're going to have to, again, net out at the end like any other liability. So what happens if you're doing a deal and there's a loan still hanging out there and it may be forgiven? Well, what we're seeing is that a lot of people are either escrowing it or I'd say probably the majority of the people are escrowing that amount and waiting accordingly. Not many people are holding up their deals because of the PPP loan. They're escrowing the funds and waiting to find out whether it's going to be forgiven. And hopefully we'll find that out here shortly. Okay, so let's move on to Live Oak Bank's Q4 2020 survey. So this Business Pulse, which is powered by Barlow Research Associates, provides a detailed analysis and reporting on small business sentiment, including economic position, economic confidence, and credit outlook for small and mid-sized companies. Part of this research was 2,800 companies here domestically in the United States. And so let's go ahead and take a look at this. First things first, no surprise, small business owners are bracing for the impact of the presidential election. Assuming that this ever gets over, 63% of the people believe that their success at least partially depends on the result of the election. Next, which I find pretty interesting, is that, well, I shouldn't say I find it interesting. I find it telling. So small business owners are holding on to their cash, signaling dry powder. So dry powder means cash is increasingly important. So 47, at least half people, or nearly half the people, believe that having cash on hand is important. Well, we were just talking about the PPP loan. Obviously, a number of the businesses that I'm working with have a ton of cash because, they got the PPP loan, but they did not have to use it as anticipated, but they have it and it's sitting in cash. I'm assuming that this is the same kind of thing, that cash is king at the moment. And certainly there's some discussion on, what's going to happen to credit from this point forward. Okay, so continuing on, as it relates to the economic position of small businesses, based on the survey, it appears that there is increased optimism, which I'd say I probably agree with, especially now there's vaccine coming out, that there's reason to be optimistic. There is an increased sales and profitability of companies. Again, I have not seen any kind of big value bumps in the road. And oddly enough, well, I shouldn't say oddly enough, a lot of people that we've worked with have decreased hiring, so they're doing more with less, and as a result, they're increasing their cash reserves. So next, moving into the economic outlook, for the most part on this analysis or this survey, they're finding flat confidence, meaning, it's just going to be business as usual, not, it's not going to go down, not going to go up. It's just going to be flat. Again, on the economy, regardless of who is elected, they anticipate that there's going to be an increased sales and profitability expectations. And based on the forecasts of the clients that we're working with, that again is staying consistent. And then the good news is that people are going to begin hiring again and spending money on capital expenditures. So that's the economic outlook. And then as far as credit, and in this case, this is done by a bank, there's going to be a need for bank loans, and there may or may not be a decreased demand for additional credit. And I've said this on a number of podcasts, and I've wrote about it on LinkedIn and so on and so forth. The bottom line is that just because we have COVID, just because we have a new president, does not mean that businesses are not going to transfer. Certainly the baby boomers are still aging, and they're going to have to do something with their businesses. And so it would behoove the Small Business Administration to continue to facilitate the transfer of ownership. And for 2020 here, up till I think it was September 27th, they were doing all kinds of things in order to facilitate the transfer of companies, including 6 months of no payments, no interest, especially until the economy and this whole COVID stuff gets past us. I think it would probably be to everybody's benefit if credit was continued to be readily available. From here, we'll move into charitable giving. Okay, my buddy over at the National Christian Foundation had sent this over to me, and I'll share with you a little bit about it. Now, regardless of whether or not your flag flies for the National Christian Foundation or any other non-for-profit, it's still the same. So again, back to the CARES Act. Remember, the Corona Aid Relief and Economic Security Act was passed. That's $2.2 trillion of economic stimulus that was put into the economy. So one of the things also about the CARES Act was that it included a number of benefits for charitable givers, which included an expanded charitable deduction for cash gifts made in 2020 to churches and public charities, and waiving the required minimum distributions from retirement accounts. Although this has been a real interesting year for everybody, it does create some exciting opportunities for generous people to continue to maximize their charitable giving. And like this email I'm reading from says, you can give more than you ever dreamed about possible under the CARES Act, because you're able to deduct up to 100% of your adjusted gross income. So again, if you itemize deductions on your income tax returns, you can deduct charitable cash gifts up to 100% of your AGI, and may eliminate or significantly reduce your federal income tax. So if you want any information on the National Christian Foundation, you can go to ncfgiving.com, and you can find all the information that you could possibly want about this. If you need a contact over there, just reach out to me and I'll be more than happy to make the introduction. Let's move over to Deal Stats. Deal Stats is a compilation of completed deals. The Deal Stat Value Index summarizes the valuation multiples and profit margins for private companies that were sold over the past several quarters. And you can get this download at dealstats.com. Okay, let's take a look at the findings for this quarter. Not that I expect that there's going to be anything too terribly dissimilar from previous quarters, but nevertheless, let's dig into it. The second quarter of 2020 saw businesses across the economy adversely affected by the spread of the coronavirus. Right, we got that. But oddly enough, that it indicated that the multiples have actually gone back up. Either we're getting comfortable with the uncertainty, or people that had pumped the brakes on their deals are finally getting them done. So again, it does appear that the EBITDA, so earnings before interest, taxes, depreciation, and amortization, those multiples are going back up. So we had bottomed out roughly at 3.7, and now we're back up into the 5s. Same thing with the net sales multiple. So that thing has climbed to a 5-year high. Now, who would have thought that in the middle of a pandemic? So for the deals that were done in the third quarter, the net sales multiple rose to its highest level, or in this case, 54%. That's a 5-year high since the fourth quarter of 2014. So that is, again, all good news. Oddly enough, is that the EBITDA margins fall to 11% of revenue. That is kind of interesting, but at the same time, I don't think it's necessarily surprising. I don't think it's surprising at all that there's suppression in the price you're paying, and the margins or the costs that you're paying probably have either stayed or gone up. And so I would anticipate the profitability margins to shrink a little bit during the pandemic. And it appears that is, again, the same thing. So the EBITDA margin as a percentage of net sales fell to 11% in the third quarter. So out of all these deals, if you divide your EBITDA by your revenue, the average here is 11%. So you can judge your company accordingly. Okay, so when we look at the median multiple for EBITDA, it's running at roughly 4.4 times EBITDA. And that's across 18 sectors. And there was a decline in professional, scientific, and technical services. And then, not surprising, healthcare, social assistance sector went up. But I'm looking across the multiples and everything's kind of hanging in there. What do we do with this? As we look at the EBITDA multiples over the course of the last decade, there just is not a whole lot of volatility. I mean, it's not like the stock market where one day you're up 800 points and the next you're down 800. The multiples remain somewhat consistent, not deviating too much, maybe 20, 30% tops. So as a business owner or an advisor to a business owner, you should be in a position to guide your client or yourself on, just what kind of, that my business has not necessarily increased substantially or decreased substantially. It's still probably close to the same multiple that it originally was. Now, if you improve, obviously it's the same old thing. You improve your cash flow margin, you will certainly benefit from the cash flow multiples. Okay, the last couple things I wanted to share with you is asking price discounts, so the bid to ask ratio. Before we went into this recession or this economic challenging period that the coronavirus has brought on, it was really a seller's market, and there wasn't a whole lot of deviation between ask and sale price. And it was, it always ranged, roughly 7 to 10 points. Now it's in favor of the buyers. So the ask price, at least for quarter number 3, and again, this may not be necessarily too surprising to you, to me a little bit, but it went in favor of buyers. And now it was 81% of asking price. So that's a big swing, 20% off of ask. That is a real interesting statistic. And I guess what I would probably think through is, of those deals that we're trying to to get done during the pandemic. I'm reasonably certain that in order to get it across the finish line, probably the buyers and sellers had to do some things that they probably weren't necessarily, I don't want to say okay doing, but it was probably over and above what would normally happen. And so I think that 20% swing from bid to ask to sale price, I think I could probably explain that through. And there's probably some PPP money that's hanging out there that's not necessarily being calculated. Again, if I'm a seller of business, I just probably going to the market, I would make sure I shore up my value and be in a position that if I have to do or extend myself in order to get the deal done, I'm able to do that, understanding that, I may be 10 to 20% off of what I'm asking. And then lastly, the economic shutdown slows the pace of selling to a 5-year high. And this is totally not surprising, is that it took longer to sell companies. The average is roughly 211 days. And in this case, it was running 245 days. So an additional 30 days to get the deal done under this pandemic, I'm not certain that is necessarily a bad thing. I think if I'm a business seller, I'm thrilled to death that my deal got done. So that is Deal Stats. Again, Deal Stats. It's DealStats.com. I will have a link to it in the show notes. Okay, this last report I'd like to share with you is the Q3 2020 Market Pulse report that is prepared by the International Business Brokers Association, M&A Source. I guess what I want to make sure you understand is that some of their findings differ from Deal Stats. Let's look at the deals. So according to this, they're saying that 33% have delayed their closing due to not knowing what the PPP status is, meaning is it going to be forgivable? So they're still in a holding pattern. Again, like I told you before, a lot about what we're seeing is people escrowing funds in order to get their deal done. And if it's forgiven, it's extra money. If not, then it is what it is, and it's just a liability. Roughly 30% are struggling with risk allocations issues in negotiations and debate. Well, who is going to be responsible for the loan if it's not forgiven? Again, I don't see how that's the case. Approximately 85% of professional advisors say that the pandemic had an extremely negative impact on the M&A market. What's notable here is that more than double the number who say the same thing about this year's election activity. Again, anytime it's an election year, there is always uncertainty. Does not bode well in the deal making space, and it is what it is. It's been that way forever. Let's talk a little bit about based on the survey, when advisors believe that will return to normal. So nearly 30% believe it'll happen in Q1 2021. 20% believe that we'll be waiting to 2022 or later, and then a tenth believe that we're already recovered and on our way. So no surprise again. So bigger companies command bigger values. Size always means increased value, and the primary reason why is just simply risk. Bigger companies do not have the same risk profile as smaller companies. It's been that way since I've been valuing companies, that the bigger the company, the less risk there is, because there's different tiers of management. There's just levels of sophistication to own and operate a larger business is just substantially different. So again, no change here. Bigger companies command bigger values. One of the questions are, where are business valuations trending? And so surprisingly, they're not trending at all. They're just hanging in there. And based on the analysis and the survey, deal makers are not anticipating that there's going to be a big change in business valuation multiples. And in fact, as I look at the multiples that they're surveyed, the 500 to a million range dropped maybe 10%. Same thing with million to 2 million in cash flow multiples, dropped from 3.3 to 3. But again, I mean, that is certainly within expectation. And as you heard in my analysis of the deal stats, same kind of thing. I mean, you're talking a 10 to 20% swing. This is certainly not anything to be surprised about. So based on 2019 to 2020, under 500,000, there's really no change at a two multiple. 2019 to 2020, 500 to a million, you're 2.5 to 2.8. And same thing with million to 2 million in adjusted cash flow. You're looking at a 3 to 3.3 multiple. So there's really not a whole lot that has changed there. Same thing with cash at close. The funny thing is that, oh my goodness, that, it's, I don't want to say nearly identical, but it's pretty close to identical, where you're looking at cash at close running from 80 to 86%, depending on the size of the deal, and 7 to 15% based on seller financing. Again, not surprising at all. Okay, so let's look at the time to close. Let's see, we're looking at, for under $500,000 in deal size, 8 months, 8 to 10 months across the board is, again, no change, nothing surprising. So why is everybody selling? Anybody want to raise their hand on why? Right. 70% of all respondents are saying it's retirement. Again, I don't know if the tsunami of business owners that are looking at exiting is now here. I sure hope so. I've been saying this for a long time. I've been waiting most of my career to take advantage of that tsunami. Pretty much everybody is retiring, surprisingly enough. Now, here's the sad part is, they're coming into the process blind. So how many business owners that have engaged in no formal planning prior to the engagement to sell? So under $500,000, roughly 85%. $500,000 to $1 million, 75%. $1 million to $2 million, 50%. $2 to $5 million, we're running at 60%, and $5 million and up, almost 35%. So again, most of the business owners are walking into the sale process blind. They don't have any kind of idea of what they're walking into. That may or may not be I shouldn't say may not be. It absolutely is a challenge and something that business owners really need to think long and hard about before entering the market. What's selling? So this part is kind of surprising, because under $500,000, the greatest area is restaurants. And I'm thinking, who in their right mind buying a restaurant in the middle of a pandemic where the government is closing you down. So, but believe it or not, that's the high. For the $500,000 to $1 million range, personal services, healthcare, and retail, which is not necessarily surprising either. The $1 million to $2 million range is construction and engineering and manufacturing, each, respectively, about 25% each. So that's not surprising, but I can certainly understand that. Same thing with the 2 to 5 million and the 5 to 50 million. So they are both construction and engineering are overwhelmingly the things that are selling. That concludes this analysis for the Q3 Market Pulse analysis, or Q3 Market Pulse survey done by the International Business Brokers Association and the M&A Source. So that is my findings. So I'll be returning next week when I restart interviewing people. Believe it or not, before I left, 3 of my guests developed COVID, and not just asymptomatic COVID. I mean, super duper sick. So we're grateful that they've rescheduled, and we'll get back on interviewing people. So again, I wanted to thank you again for those of you that reached out. I mean, I should have hopped on, made you aware of what was going on with me. But like I said, I'm super grateful that for all of you that listen on a regular basis and reached out to make sure I was good. So thanks so much. And as always, it is a standing offer. If there is anything I can do for you in any way, shape, or form that'll help you either exit better or get you in touch with people that will help you grow the value of your company, or if I can do anything, just let me know. Thanks so much. Have a very happy Thanksgiving. I'm prayerful for everybody that we all stay healthy and our loved ones too. Thanks so much again. Have a happy Thanksgiving.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.